Good morning and welcome to the Shenkman Wealth Management Fall Webinar Series. This program is entitled Planning Under Secure 2.0 and the Proposed Regulations. As I always like to emphasize to my audience, these programs are open to all, so if you have a colleague, client, or friend that would like to receive notifications of my upcoming webinars, just have them email me directly at jonathan@shenkmanwealth.com with the word webinar in the subject line, and I'll add them to the distribution list. By way of background, for those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, to name just a few. You can also see my work on my website at shenkmanwealth.com/articles or by following me on social media at Shenkman on Money. Additionally, I just launched my podcast, which is also called Shenkman on Money, and you can check that out on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Bruce Steiner, who's of counsel at Kleinberg, Kaplan, Wolff, and Cohen based in New York. By way of background, Bruce has over 40 years of experience in the areas of taxation, estate planning, business succession planning, and estate trust administration. He's a frequent lecturer at continuing education programs for bar associations, CPAs, and other professionals. He's also the co-author of CCH's Roth IRA Answer book. Bruce is also a commentator for Kleinberg Information Services, is a member of the editorial board of Trust and Estates, is a technical advisor for Ed Slott's IRA Advisor, and has written numerous articles for estate planning, BNA tax management, Estates Gift and Trust Journal, and many, many more. Bruce has served on the professional advisory boards of several major charitable organizations and has been named a New York Metro Super Lawyer by Super Lawyer since 2010 and recognized by Best Lawyer since 2018. Today, Bruce will be speaking on planning under Secure 2.0 and the proposed regulations. And with that introduction, I'll now turn the program over to Bruce.
Jonathan, thanks for having me back. We're going to talk about planning for retirement benefits in light of Secure 2.0 as well as Secure 1.0 and as well as the proposed regulations. There's a lot of material and we only have a half hour, so we're really going to have to make this a quick run through just because we could spend a whole day on it. So if there's anything that you want to discuss in greater detail, we'll have to do that some other time. We have to first understand how IRAs work. A traditional IRA, in general, the contributions are deductible, and the money in there, while it's in there, is not taxable, and when it comes out, it generally is taxable. A Roth is the opposite. In a Roth, the contributions are not deductible, and the earnings within the Roth are not taxable, and when it comes out, with a few exceptions, it's tax-free. So at a constant tax rate, you would think that they're identical, and we'll go into when that is and when that isn't. In an IRA, with a few exceptions, you control the investments. In an employer plan, it depends on the plan. Sometimes you have a lot of control, sometimes you have a little control, and occasionally no control at all. There are contribution limits, and in an IRA, it's $6,500 a year, $7,500 if you've reached age 50. And if you put in more, it's subject. There's an excise tax on the additional in the excess. The defined contribution limit is $66,000 a year, and the 401k limit is $22,500, $30,000 if you're over age 50. And so, if you are able to put in as much as you're able to put in, and you start early and you let it grow for a very long time, it's going to be a very large amount of money, even if you invested average minusly. And we would hope that on average people would could invest it averagely, but even if you invest it a little below average, you will still end up with a great deal of money, especially if you start early. In a traditional IRA, the benefits are part yours and part the government's. The government share is the tax rate, and your share is the rest of it. Your share grows tax-free. Don't think of it as tax deferred, think of it as tax-free. So let's say you're in a 40% bracket, you put in $6,500, it grows to $65,000, you take it out, you pay your tax, you have $39,000 left. But your share of the IRA, 3,900, grew to 39,000, tax-free, not tax deferred. You're not trading capital gains for ordinary income. Your share is tax-free, because if you didn't make the contribution, you'd have paid the tax up front. You'd have had $3,900 left. It wouldn't grow to quite $39,000, no matter how careful you were to invest entirely in stocks that didn't pay dividends, because sooner or later, one of those stocks will pay a dividend or will get taken over for cash. Or maybe your investment allocation is not 100% in non-dividend stocks. You need a lot of other money to invest in other kinds of things to be able to do that. And for most middle and upper middle class clients, the IRA is the largest asset, and so you can't really do that. A Roth is just a larger traditional. Suppose you put $6,500 into a Roth IRA. Again, since a traditional is part yours and part the government's, that's as if you contributed close to $11,000 to a traditional, except you're not allowed to do it. So everything else being equal, the Roth always wins. There's an additional benefit to the Roth if you can convert or withdraw at a lower tax rate. But if you would have to convert or withdraw at a higher tax rate, that's a countervailing factor and a disadvantage to the Roth. So what some people do is while they're working and they're in a high bracket, they use the traditional, and when they retire, if they're in a lower bracket, they fill up the lower brackets with Roth conversions. We'll talk about that a little bit later. By converting to a Roth, if you have other money with which to pay the tax, it's like putting in the amount of the tax into the Roth, because the Roth is all yours. So let's say you're retired, you're in a 30% bracket, you've got a $100,000 traditional IRA and $30,000 cash, and you convert, you now have a $100,000 Roth IRA, and let's say it doubles to 200 over the next so many years. If you didn't convert, your traditional would still grow to the same 200,000. You'd withdraw it and you'd pay the tax and have 140,000 left. But your taxable account, for the very same reason, it grows to less than 60,000, because you pay tax on the income and gains each year. By converting and paying the tax out of other income, you've effectively made a substantial additional contribution. So when do you convert? It gets complicated if your tax bracket is higher now and it'll be lower later. It's complicated if converting all at once bunches the income into a higher bracket. So for most people, you might spread the conversion. You might convert a little bit each year. If you're always going to be in that top bracket because you have plenty of other income, you'd probably just convert all at once, or maybe not at all if you're going to just leave your IRA to charity. So many people convert up to the top of the 12% bracket. There's often a window between when you retire and when you turn 70, and Social Security benefits have to begin. You don't literally have to take it, but you don't get any additional benefit by waiting past 70. The widening of the joint return brackets through 2025 lets you convert at no more than 24% up to about $364,000. So somebody with a several $1 million IRA, maybe you have a $10 million IRA, and you don't have much other income, you can convert up to $364,000 of taxable income and still be in what I would call the middle tax brackets of up to 24. Some other changes, Secure 1.0, it's sort of like World War I. It didn't get called that until World War II. So now the original Secure is Secure 1. It used to be you couldn't contribute to a traditional if you were going to be 70 and a half that year. That's repealed any age. There are backdoor Roth conversions, since there are income limits to contribute to a Roth or to deduct contributions to a traditional. You can at any age, at any income, you can make a non-deductible contribution to a traditional and then convert to a Roth. The problem is if you have other traditional IRAs, your basis gets prorated. So to avoid that, if you're in an employer plan and the plan accepts rollovers, you can take your existing traditional and roll it into your employer's plan, which you may or may not be allowed to do, and you may or may not want to do, but it's a possibility to keep in mind. And some employer plans allow, in addition to the deductible, in addition to the 401k portion that's either deductible or can go into a Roth, they allow additional contributions to the plan on an after-tax basis. Now let's get into the changes in the distribution rule. So it used to be 70 and a half year was the year of your first required distribution. And in the case of the first year, you could defer it another 3 months and just double up in the second year. Secure 1 increased it to 72. Secure 2, it is now 73 for people turning 73 now or after this year. And in about 10 years or so from now, it'll become 75. So that gives people a lot more deferral because they don't have to take money out as soon. And it gives people additional years that they can do Roth conversions at lower brackets because they don't have to yet take RMDs. So that's something to keep in mind. There's some exceptions to RMDs. No required distributions from a Roth IRA. Under Secure 2, there's no RMDs from a Roth account within an employer plan. In the past, there was, so you'd have to roll it out into a Roth IRA. That's no longer a concern. And if you're not a 5% owner, you can defer until retirement. And interestingly, if you own exactly 5%, you're not a 5% owner because a 5% owner means more than 5%. Qualified charitable contributions, QCDs. Once you turn 70 and a half, and that 70 and a half did not change to 72 or 73, you may direct up to $100,000 a year out of your IRA directly to charity. Now, why would you do that instead of just taking your required distribution and then writing your own check to charity? Well, under the 2017 Act, at least through 2025, the standard deduction is way higher than it had been before, and the deduction for state and local taxes is way less than it had been before. So almost everybody takes the standard deduction. So it lets you double up. You get your standard deduction and you get the effect of a charitable deduction by having money go directly from your IRA to charity. And I really do think that is encouraged charitable contributions because people don't feel it that much because they're not directly writing the check. They're having the money come out of some account that they're probably not going to use most of it for a while. So it's a wonderful, wonderful thing to consider. If you're not yet 70 and a half, you can replicate that by every several years itemizing and donating a big slug of money to a donor advised fund and then making your charitable grants out of the donor advised fund until it runs low, and then you can replenish it. RMDs, it used to be life expectancy for any designated beneficiary, and trusts could generally use the oldest beneficiary. And if you didn't have a designated beneficiary, if you left it to your estate, it was the 5-year rule if you died before your required beginning date and And on or after your required beginning date, it was over your life expectancy as if you hadn't died. And now we have a new category called an eligible designated beneficiary, which is a disabled or chronically ill person. So if you're just what Natalie Choate calls a PODB, a plain old designated beneficiary who's not an EDB, there's a 10-year rule. It's got to be taken out by the end of the 10th year following the IRA owner's death. And under the proposed regulations, if the IRA owner had reached his or her required beginning date, you have to take some annual distributions in the first 9 years. Because it's only a proposed regulation, the IRS has waived that through the end of 2023. We'll see what happens afterwards. If somebody died before 2019, the designated beneficiary still gets the life expectancy stretch, but once they die, the 10-year rule kicks in. So somebody died in 2018 and their child gets the life expectancy stretch. If they died before they reached their life expectancy, whoever they leave it to, the 10-year rule kicks in. So we'll probably have more Roth conversions, because if the 10-year rule applies, let's say somebody has a $2 million IRA and the beneficiary has to take out $200,000 a year for 10 years, that's going to throw them into a much higher tax bracket. So the IRA owner may want to do some Roth conversions to avoid the bunching. It used to be you would leave IRAs often to or in trust for grandchildren because they had a longer life expectancy. That's no longer relevant due to the 10-year rule. You won't have as much life insurance to pay the estate tax on the IRA, because it's got to come out within 10 years anyway, most of the time. But there are new uses of life insurance we'll cover later. An EDB, an eligible designated beneficiary, spouses, minor children, disabled and chronically ill, or somebody not more than 10 years younger than the IRA owner, still gets the life expectancy stretch. Once that person dies, the 10-year rule kicks in. And if it's a minor child, and nobody really wants a minor child to gain control at a young age, if it's a minor child, the 10-year rule kicks in when they reach 21, and nobody really wants a minor child to gain control at 21 and to receive all the money by 31. So that's not of much use. So the planning technique, it used to be if one child was disabled and one wasn't, you leave the IRA to the one who wasn't, and other assets for the disabled child to avoid the so that the non-disabled child could spread it out, and the disabled child, you wanted money in trust rather than outright. Well, we want everybody's money to be in trust rather than outright, to keep it out of their estates and protect against their creditors and spouses. But if you leave the IRA in trust for the disabled child, it gets the life expectancy stretch, which the non-disabled child can't get. That's a key takeaway. The definition of disabled is the same as it is for Social Security, which is a very difficult test to satisfy. If you're getting Social Security, you're for sure you've qualified. So you would provide for a disabled person in trust. Usually, because a disabled person probably don't want having money outright. Again, we provide for all of our clients' children in trust rather than outright. But a trust for disabled, in order to qualify for the life expectancy trust, it's got to be a one beneficiary trust during that person's lifetime. Well, you could have other beneficiaries if they're also disabled or chronically ill, but that doesn't happen very often. And then once that person dies, then the 10-year rule kicks in. So if you have a disabled child or maybe niece or nephew, that's really a thing to consider, is to leave the IRA in trust for them, and it gets the life expectancy stretch. Pre-secure 2, if you had a charity as a remainder beneficiary, you didn't have a designated beneficiary. For a disabled or chronically ill, that the charity is disregarded, and it still gets the life expectancy stretch. That's helpful, because many people with a disabled child, there's some charity, some nonprofit that that was helping that person, and they want that charity to get the remainder, or maybe they've already provided for their other children sufficiently, so they want charity as the remainder. Now, our clients generally provide for their children in trust rather than outright. So for the very same reasons, you might want to leave the IRA in trust rather than outright. It keeps it out of the child's estate and protects against their creditors and predators and spouses and Medicaid. The trade-off is that trusts pay tax at higher tax rates, and there's some administrative effort to administer a trust, and you need to find trustees. So one solution to the higher tax rates for trusts is to do Roth conversions while you're alive, especially if you have a window when you can do it at not too high a rate. And because otherwise the trustees either accumulate the money and pay tax at the top rate, or they distribute and lose the asset protection of the trust. We spend a lot of time dealing with state income taxation of trusts, which go up to about 13 in California, and I think about 14 or so in New York City, and states like Oregon and Minnesota, and there's a few others that are in the very high single digits. Maryland is in the high single digits, and quite a lot of states are in the 7 or so range. And different states have different ways of determining when a trust is a resident trust in their state. I live in New Jersey. Jonathan lives in New York. I create a trust. Jonathan is the trustee. It's not taxable in either state. New York and New Jersey look to where the grantor is located. And New York, even if a New Yorker creates the trust, if the trustee is not in New York and there's no assets or income from New York won't tax it. With New York has a throwback rule. Other states, about half the states, tax the trust based on where the trustee is located. So that's easy. You just don't have the trustee in a state that'll tax the trust because the trust is in that state. For regular trusts, this isn't all that important. If I've got a $1 million trust of other assets and it's producing, I don't know, $30,000 a year of income, stocks yield, I don't know, maybe a little less than 2, and bonds were yielding close to 0 for a while. Now they're, I don't know, 4 or 5, whatever it is. So a mixed portfolio, maybe at page 3. So you got 30,000 a year of income. Maybe you don't really care about state income tax on 30,000 a year, but in a traditional IRA, it's all in taxable income. So you really do care about it. So you really have to look at it. New York has a throwback rule with a bunch of exceptions. California has a throwback rule that's much more comprehensive than New York's, but the throwback rule only applies when the money gets distributed to somebody in California. So if nobody needs the money for a long time, it's still a tremendous benefit. You can have a conduit trust where all of the distributions from the IRA have to be paid out on a current basis, and you get to disregard subsequent beneficiaries. The problem is that it forces out all the IRA, so it doesn't have much purpose, with the exception of maybe if it's for an EDB where you get the life expectancy stretch, if it's a conduit trust, or occasionally for a spouse, because if it's a spouse, you get to recalculate the spouse's life expectancy each year. So a conduit trust for a spouse is sort of a trade-off between the rollover where the spouse controls it and a discretionary trust where the spouse has no control, and it's sort of a middle ground, and the rollover is less valuable due to the 10-year rule in secure. Our normal trust is what everybody calls an accumulation trust, where the trustees have discretion to accumulate the money in the trust. They don't have to; they can distribute it out to beneficiaries, but they may accumulate. In determining who the beneficiaries of a trust are, a major change under the proposed regulations is you disregard permissible appointees under a power of appointment. We normally want to give beneficiaries broad powers of appointment if we're leaving money in trust for a child just for asset protection, but we want the child to control it. We let the child appoint, meaning give or leave the trust assets to anybody they want except themselves. and you get to disregard you get to disregard under the proposed before the proposed regulations, a broad power of appointment disqualified your trust because the child could appoint to charity, the child could appoint to somebody who was older, so you had to eliminate charity, you had to eliminate anybody older than the measuring life. All of that is gone because under the proposed regulations, you ignore permissible appointees. So it makes your drafting much easier if you're providing for charity. The beneficiaries of a trust have to be identifiable. Class additions are permitted, like a new grandchild being born. Being able to modify a trust. I got to call you back. Trust modifications are okay if you add beneficiaries. They don't count until after they've been added. The thing I wanted to save my last few minutes for, a charitable remainder trust replicates the stretch. Let's say I'm leaving my IRA to my child who's got to be at least 25. If I leave it to them directly or in a conventional trust, it all has to be paid out within 10 years. If instead I leave it to them in a charitable remainder trust, which is a trust that the child gets a percentage of the value of the trust each year, at least 5%. So at 25, it would be 5%. If you're like around 40-ish, it's about 6%. And then when they die, whatever's left goes to charity. And the value of the charity's interest has to be at least 10% of the initial value of the trust. This is a wonderful technique. It replicates the stretch. The benefit of being able to spread the payments out over the beneficiary's lifetime is likely to outweigh the loss of 10% of the value to charity. And a lot of people are comfortable with charity and they don't really care if some of the value goes to charity. And they certainly don't care if some of the value goes to charity if it's the government's money that's going to charity, because the beneficiary is even better off or equally well off as he or she would have been otherwise. So you should really consider that if you've got a beneficiary who's relatively young, who's going to need distributions, who doesn't expect to have a taxable estate, is at low risk of creditors and divorce or Medicaid, and when there are other assets available for one-off needs, because the charitable remainder trust, the payments are defined by a formula. So there's going to be 1 year when the person might need more money to buy a house or a boat or a car. So there has to be some other assets available. The trust is itself tax exempt, but the distributions are taxable to the extent the trust had income. And since the IRA is generally all income, for 20 or so, 15 or 20 years, the distributions will all be considered IRA money, ordinary income. And after that, it depends on the character of the trust income. The trade-off really is that the CRT is inflexible, and with a very narrow exception, the distributions have to go outright. So it's got to be a beneficiary who you don't think is going to have a taxable estate, somebody who's going to need the money. You probably use the money, but that comes up more often than you might think. It's hard to have a charitable trust with two lives. For example, if you've got two children 2 years apart, they've got to be at least 38 and 36 for it to work. And then you can do it. You can have a trust or to the two of them equally or in full to the survivor, or you can have first to one and then to the other. You can also do a 20-year charitable remainder trust, which would be I don't know why I said April, but the rate is the same today. You could do a 20-year trust with about an 11% payout, but you wouldn't do that complexity because you get 10 years without such a trust. Charitable remainder trusts file annual tax returns on a special form, and in some states they have to register with the Attorney General. A real trap in New Jersey, they are not tax exempt. They are taxed like any other trust, which means if you've got $1 million IRA, the whole $1 million would be income for New Jersey in the year it's collected. The workaround is just have your trustee be somebody who does not live in New Jersey. There's 49 other states you can pick a trustee from if you're for somebody in New Jersey. And there's no throwback rule, and there won't be any other kinds of any real estate or anything because it's an IRA. So just keep that in mind. Missed IRDs, there used to be a 50% penalty if you didn't take your RMD, and you could ask that they waive it. The history of the world is I've never heard of anyone who's requested to waive it has not been granted. It's now 25%, and it's 10% if you correct it timely. One wonders whether waivers will be as easy to get as they had been before if the penalty is lower. But you should take your RMD on time and not be the test case. Prohibited transactions. The principally self-dealing is the major prohibited transaction, and unlike in a charity where there's or in a foundation where it's a modest percentage penalty, in an IRA, if you engage in a prohibited transaction, the IRA is no longer an IRA. So some people have raised the question as to whether if I have a questionable transaction, if I just put the money for that investment into a separate IRA, do they get aggregated or is it standalone? And Secure 2 says it's standalone. So if I'm going to do an investment that might or might not be a prohibited transaction, I should segregate the money into a separate IRA, maybe even a Roth IRA, because if that ceases to be an IRA, there's no immediate tax. I just no longer have a Roth IRA. My view of things that I'm not sure if they're prohibited transactions or not is not to do them, but some clients are more aggressive about it and they want to do it. So that's what they should do. I think we've used up our time. Jonathan, it's all yours.
Great. Thank you so much, Bruce. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Bruce or myself where appropriate, and I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 4 more quick items before I let you go. First, my fall webinar series continues on October 12th on the topic of taxation of supplemental needs trust, featuring Amy O'Hara, who's a partner at Lippman Crooks based in Westchester, New York. Again, if you have a friend, colleague, or client who would like to be notified of my fall webinar series, they can email me with the word webinar in the subject line, and I will add them to my distribution list. Second, you can follow all my work on Twitter, YouTube, or Instagram at Shenkman on Money, and you can also listen to my new podcast called Shenkman on Money, which is available on Apple, Spotify, or wherever you get your podcasts. Third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And finally, I want to wish everybody who's celebrating Sukkot to have a meaningful and enjoyable holiday. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.